So Stockland's the largest diversified real estate company in Australia. We've got around 15.8 billion, which is split between our trust and our company. So within the trust, that represents about 70% of our assets, and half of all assets are in shopping centres. About 18% are in logistics and business parks, and 8% in office. And then 20% in residential, and just under 10% in retirement living. And that makes up our asset base and translates into around 70% of assets providing recurring, reliable income. It was a strong set of results for the first half that we reported, with growth in all business areas. We saw a statutory profit come in a bit over 700 million, up 0.7%. The key metric for us is funds from operation, which grew 7.8% to $369 million. And our earnings per security was up 6.2% to 15.4 cents. As a result of that growth, we saw the return on equity increase also to a strong 11%. Distribution growth is for the year forecast to be 4%, and through the cycle we seek to achieve earnings growth between 4 to 6%. And given the relative strength of our current performance, we increased our funds from operation guidance for the coming year to 6 to 7% growth. So we continue to maintain a conservative balance sheet with total debt to total assets sitting just under 24%, weighted average debt maturity just under 6 years, and hedging over 90%. So operationally, as I mentioned, all business areas reflected growth. In this period, FFO growth from residential was very modest. It was only 1%, although we had record sales up 42% on prior corresponding period. And we have a typical skew to the second half. So we'll see solid double-digit growth from residential over the year. So that growth in the first half was more about timing. On the commercial side of our business, we saw funds from operation growth of 3.7%, which was reflected by strong leasing across the portfolio, particularly in Sydney office and our logistics assets. Solid sales growth per square metre in our specialty sales, sitting at 3%, and a good tenant retention, high occupancy, 99.5% in the shopping centres, and overall very strong customer satisfaction. So our retirement living business was really strong in the half. Profit growth was up almost 44%, reflecting a combination of a 200 basis point improvement in operating profit margin, significant increase in occupancy, and also in the period we had a timing with a number of super lot sales in the first half, which won't be in the second. So for the year, retirement living will still also see double-digit growth. So the residential market's been strong, and obviously there's a lot of talk about affordability and also the duration of the cycle. First and foremost, we've been very focused around affordability. So half of our sales go to first home buyers, 75% go to owner-occupiers, and less than 1% are sold to offshore buyers. So we've got really affordable product. You can buy a house and land package in a Stockland community at an average discount of about 18% to the median price in that trade area, and we'll continue that focus looking forward. We've been buying land and development opportunities with a focus on the eastern seaboard, and we'll continue to do that. But now that we're seeing Perth starting to show a basing, we're also interested in adding counter-cyclically to our Perth exposure. So we expect to have a strong full year, and by definition a strong second half, and overall we're looking for 6 to 7% earnings per security growth, and that will reflect continued strength in our retirement living business and commercial business, similar to the first half, with some moderation in retirement living around timing, and a significant step up in growth from the residential business as a result of the timing of settlements towards the second half.